Welcome back to the market matrix. Today we're going to speak about a pattern that is called the symmetrical triangle. Now, we went over a bunch of patterns at this point. We went over the double bottom, the double top, the triple bottom, the head and shoulders, inverse head and shoulders, cup and hand, all these patterns, we went over them. Now, what did we notice is a lot of them, most of them have inverses. So for the double bottom, we had the double top, which was basically the same thing, except it was flipped. For the head and shoulders, we had the inverse head and shoulders, which again, same thing, basically flipped. And then we had certain things where it was like, let's say we had the rising wedge, and then we had the falling wedge, where in the broadening bottom and the broadening top, some of these, like, they don't look exactly inverse, but you get the idea of it. Now, last we spoke about was the ascending and descending triangles. The ascending triangle consisted of price action getting squeezed into this higher price range. So this price range up here was constant. It was the same, but this was the same. Resistance was the same, but support kept squeezing higher, meaning the buyers kept stepping in, creeping up the price until he eventually squeezed above this price. The descending triangle now was quite the opposite. We had the price that was like this, holding the same support, but the sellers kept stepping in, eventually breaking the price lower. So now, let's speak about the symmetrical triangle. Now, the symmetrical triangle is going to remind you of a pattern we spoke about, which looks like this. And if you guessed bullish pennant, then you guessed it right. We had the price that was squeezing in between this until it came to the middle point and it broke above the triangle. Same thing with the bearish pennant. We had something like this, where price was squeezing tighter until it broke lower. Again, as I mentioned in the other videos, the price could have squeezed above on a bear pennant, but it was very unlikely. Same thing with the bullish pennant. Price could have went like this, and went like this and this, but it was not as likely as it going up. So let's get into the symmetrical triangle and let's see what it's about. So we have the price action over here that's just bouncing around. We're not getting any direction at this point. You notice with a lot of the other patterns, we had a big move down or a big move up or something to give us sort of some significance. Or the cup and handle, we had this rounding bottom showing that, okay, it went down, buyer stepped in, sending it higher. With this pattern, we don't necessarily have any direction at this point. But what we see, if you look closely, is this over here, We see trend lines. We see sellers stepping in over here, sellers over here, sellers over here, sellers over here, buyers over here, buyers over here, buyers over here. So we see that as it's happening, and it's good to notice that, because what can you see is that this is a pattern called a symmetrical triangle. And why is it called that? Is because, well, it's sort of symmetric. The price gets squeezed into this middle point over here. So a lot of times, this and this are going to be, give or take, about the same range. Now it might be different because a lot of the times what we can see is this trend resistance can start somewhere up here while this one starts over here. And vice versa. This trend support could start somewhere over here while this one starts over here. But you need to also know that this pattern doesn't necessarily have to come from an up move or a down move. So the stock doesn't have to come down and then do this. The stock can be basically flat and then decide to do something like this. It can come from an up move and then sort of get out of whack and then do something like this. So this pattern comes in different ways. Now, again, what we spoke about, buyers stepping in, buyers stepping in, buyers stepping in, buyers stepping in, sellers, 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 sellers. So if we take a look closer into this, let's say this is $5 over here and this is $1 over here. This middle price will be considered $3. What's going on is that the buyers keep trying to send it higher, but at the same time, sellers keep trying to send it lower, and neither side is giving up, so they both keep just fighting it out until the price is in this middle point, which between 1 and 5 is 3. So let's call this 3 over here. At this point, what can we assume? We cannot assume that the price is going to go higher. We can't assume that the price is going to go lower. So if you just decide to make these assumptions because you feel like it, then that's wrong. But if you have other indicators, maybe moving averages, RSI, strong volume on one side, a lot of different indicators you can use to maybe tip the scales in your favor and see the probabilities and what side the probabilities lay out on, then maybe you could assume something. But at this point, with just this, we cannot make any assumptions because this can go up, this can go down, and we don't know up until we get a break. But let's look at this. The measured move for this pattern we should expect is from the bottom over here, this trend support, up to the top of this trend resistance. So where we see the resistance starting off, the topping of it, that is where we should measure this move. Now, where we're going to add that is either going to be over here if it breaks low, or up here if it breaks up. So let's get into why we need to wait. We need to wait because, like I said before, you can't make the assumption that this thing breaks over here or breaks down over here if you're just looking at this. Because you literally just have this at this point. Price is right here, right in the middle. Why would it go up? Why would it go down? What's the reason? So if, let's say we get a break above this trend resistance over here, again, this trend resistance over here, if we get the break above it, we can now anticipate that there's a higher chance that this will go up. Because at this point, when they were squeezing, okay, buyers stepped in over here to eventually break it out of this range, break it out of this trend that it's been in. The trend is now broken. So we can assume that there's a higher chance that this will continue higher. Now, is there the probability that this goes back down? Yes, there is that probability. At any given point, there is always the possibility, no matter what type of trade you put on, that that trade goes against you. And I don't care if you're a retail trader, a hedge fund, Warren Buffett, whoever you are, at any given point, there is always risk. At any given point, the trade can go south. There's many instances where hedge funds are wrong about a position. Billionaires are wrong about a position. But here's the difference. A lot of these institutions or high net worth individuals have a lot of money. So they can back that position. They can manipulate it. They can manipulate the stock. They can do a lot of different things to make it go in their favor. But we'll save that for another day. At this point, what do we know? Stock broke up here, so the chances of it going higher are higher, and the chances of it going lower are lower at this point. But let's say we get something like this. What are we going to assume now? We assume that, okay, sellers ended up breaking it below this triangle. Price was squeezing between this price. By the time it got towards the end of this triangle, the price broke below. So we're anticipating it to continue lower. So we grab this measured move and we'll add it over here. And this is the move we should expect. Now again, can this stock go back up over here? Absolutely it can. A lot of times what might happen is, let's say none of this price action happened yet, and just from over here, boom, stock went like this. It can come back to the triangle. I've seen that happen many times where the stock breaks out of the triangle. In fact, I've seen it today, where the stock breaks out of this triangle, and then it comes back into the triangle, and either goes lower, continues higher, or does whatever it does. But, again, anytime you enter a trade, you are going to have to monitor the trade. You're going to have to get in the trade and see what's going on constantly. Maybe it goes down this much and then buyers step in aggressively and send it higher. At that point, you need to be able to adjust. You need to be like a chameleon. Chameleon is walking on, let's say, the grass, and the grass is green, he turns green. If he's walking on some leaves and the leaves are brown, he turns brown. You need to be able to be like that. You need to be able to adapt. So that's one of the things with this pattern. Well, that's many of the things with this pattern. It's basically everything. And you'll probably see this a lot. Again, you might see it come from an up move, from a down move, from a sideways move. And from there, you can use your judgment to know which way to trade it. And if there are certain patterns that you don't like trading because for the fact that they might be a little confusing, it's simple. Just don't trade them. Just don't trade them. Learn how to trade it. Maybe trade it with a paper account. Or, just don't trade it and see what happens. And yeah, just take advantage of what you do know how to trade, what you're comfortable with trading, and the rest just be patient, work on a discipline, and all the other pieces. So, thank you for watching this video, and I hope to see you in the next one.